how do we get the numbers that will ultimately appear in the financial statement? The first step in our process is to determine how a business will raise funds, what we call financial activities. Actually, all companies, small businesses, partnerships, proprietorships, or corporations, they do three activities. The first one is financial activities. The second is investing activities. And the third is operations activities. We're going to see all those three activities later on. Let's start with financial activities. Right? We're going to write down. Where will the capital the company needs come from, and from what source? We have two options. Either the owner, the business owner, will contribute and submit some money to the bank to raise his or her capital of his business. And the second option is to borrow money. We are going to see those two options. Option number one. We are going to get money from the owners, which is contribution. Contributions go to owner's equity. Okay? Second option is borrowing money. That goes to liability accounts. Okay? It's a debt. And we are going to illustrate that on T accounts. A T account has a debit and credit. Think of when you go to your bank, you withdraw money. So that money belongs to you, is a debit. However, when you pay a bill and you spend money, that is a credit from your pocket or from your wallet. So we always have two transactions. We have debit and accounts and credit and accounts. If you buy, you are going to credit your accounts and debit and another account which is expense. Okay, so two accounts, debit and credit. That's how the T account functions. Okay, I'm gonna withdraw. It looks like a T. Okay, and it has a debit and a credit. Debit, it's usually presented by letter D, okay? And credit usually is presented with CR to say is a credit, okay? Now, let's say the business owners gave the company some money. We're going to say, for example, $10,000. So we are going to debit what? To debit our bank, because we received that money. from the business owner, we're gonna put it into our bank account. So we're gonna name this T account as a bank account. Okay? I'm gonna circle that in red. So from your chart of accounts, you are going to list the bank account with its number when you book the bank account. So we are going to debit our bank account with 10,000 that the business owner gave to the company. So basically, we debit our account with $10,000, and then we are going to credit another account. That account, since it has been submitted by the business owner, it goes to the owner's equity account. It's going to increase that owner's equity, since we increased our bank with 10,000 and as a debit, and then we are going to increase the owner's equity by $10,000 as well. Okay, so we're gonna put that in a T account, always debit, credit. So since we debited our bank, we are going to credit our owner's equity. So we're gonna name it owner's equity. We are going to book this under credit. Okay, debit, bank, credit, owner's equity. And by the way, in accounting, you always have two transactions, debit and credit. Debit an account, credit another account. The second option, which is borrowing money, you remember? That is the second option. We are going to write the same transactions but with different accounts. Okay? So have a T account. We have again two accounts. One is borrowing money from our creditors. Usually it's a note that we can put under payables. Note payable. Okay? We're gonna call it not payable. And that is under your chart of account as well, under liabilities section. Okay? So we always have debit and credit. So what happened here? We are going to credit note payable, which is a liability. It's due. We have to pay it back. It's a debt. So that transaction, we're gonna credit the creditor. Let's say we borrowed $20,000. So we are going to credit not payable, which is a liability, $20,000. And we are going to debit our bank. We got that money, we are going to deposit it in our bank. So two accounts, two T accounts, debit, credit, and we're gonna name it our bank. And since we credit not payables, which is liability, we are going to debit our bank. So let's think of when you borrow money, you owe that money. And then when you receive that money, you own it. Okay? So we are going to deposit it into our bank accounts. All right? Same thing, $20,000. All right? So whether it is a small sole proprietorship, a partnership, or a large corporation, always increase its value, its capital. Okay? The owner gave money to the business, and in return, the business simply offered them an opportunity to make a profit. That's the purpose of doing business. The business must succeed in making the owner's investment to ultimately be realized. But in terms of how we account for the transaction in financial statements, we're talking about a win-win situation. So the company received the value of the funds transferred by owners, and in exchange, we simply create a future opportunity. So the company doesn't really produce any tangible results. The second financial option that we just saw is borrowing. Okay? Does that mean all borrowing is a bad business decision? No, of course not. But borrowing imposes a repayment obligation on the company. So yes, it receives the value of the borrowed money, but it has also a corresponding liability or debt on its books. So borrowing money creates liability. And as we will see later, that liability is the obligation to repay the debt at a later date with interest. Once we have decided how, and generally for most companies, it's a combination. We don't just borrow money, accept contributions, or issue shares. We usually combine the two. Okay? All companies functions this way. They have their own money, and in the meantime, they borrow money for future investments. All right? That is going to be the second activity, the company activity. We're going to call it the investing activity.